Good afternoon. My name is Thomas Seneca with TM Wealth Management. Great to have Matt Hartson, our Chief Investment Officer, with us today. And just kind of wanted to take 30 minutes as we get through kind of our second half outlook. We've kind of hit the halfway point for the year. And we had some thoughts at the end of last year, beginning of this year, kind of how the things were going to go. And of course, as the saying goes, men have plans and God laughs. And so I think that's kind of apropos of the experience thus far this year. A lot of things couldn't have been anticipated, but really wanted to just give everyone, Matt, kind of an outlook of kind of how did the first half go based on what we thought, and just give us a snapshot, maybe on the macro level of kind of how the first half has gone, both from an economic and market standpoint.
Perfect. Yeah, I think if you look at the markets, we'll give away the punchline. If you've covered your eyes for the whole first half of the year, you've had an exceptional first half. But there certainly has been a lot of excitement as we've moved into there. So I think that's, definitely made it interesting from most people's perspective.
Absolutely. If you wanted to kind of bring up some slides that we want to kind of walk people through and kind of share with them a little bit about kind of how the beginning of the year has gone, and how some of the themes that we thought about have played out.
Yeah, absolutely. So, our key takeaways here, we've got the excellent start, I said here, to 2026. We talk a little bit today about our positioning and changes, and as you mentioned, kind of that outlook then as we move forward. So, maybe starting, with excellent start, you'll notice there aren't a lot of aren't a lot of bars here below the line. And so, the one area that you see a little bit of negative on a year-to-date basis, and this was updated through Monday of this week, is U.S. bonds have basically been flat for the year. And we can jump into more about what's happened there and what's driven that, but driven largely by interest rates and obviously the war in Iran bringing inflation up, some of those pieces. But if you look across the other asset class, diversified portfolio first half of the year at 5.3%. I don't think we'd have a lot of clients complaining about that particular number.
Yeah, I think, as looking at, just the overall asset classes, right? The S&P, roughly just a little below 9% year to date. If you kind of just do the math, right, that puts us on about an 18% run rate for 2026. I think, looking at the different asset classes, how they've performed over the last year compared to this year, it feels somewhat similar, although, we're dealing with different things, right? Last year it was tariffs. This year it's AI and Iran. And I think we started to put some things in place for clients in the overall portfolio construction that are really starting to kind of play out. And maybe be helpful, Matt, to talk a little bit about some of those adjustments we made at the beginning of the year that are really starting to, not starting, but continuing to provide not only gains in the portfolio, but also some of that risk management as well.
Yeah, no, that's great. Let me just jump ahead a little bit to some of those key changes that we made in the portfolio as we looked at some of that restructuring. As you remember, we really reduced a little bit of exposure, took some profit in the large cap core portion of the portfolio, brought in international emerging, which you may have noticed on that other slide that we were showing was one of the best performing asset classes on a year-to-date basis. Maintained our position to foreign developed market stocks, and then brought in some of those alternatives I think you were specifically alluding to. And what was really interesting is we've seen down months this year. We've seen a couple of tough months. That diversification has really played out for us, as you were mentioning, and we've certainly seen some strong returns from some of the alternatives, some of the other components that we have within the portfolio there.
Yeah, it's kind of one of those things that a lot of times we don't really feel the benefits of diversification and the asset allocation, but as we look, kind of on a over time, really get to see that, hey, it's nice to have, emerging markets up 30% last year and high teens this year so far. And while bonds are providing that buffer, really kind of softening the overall portfolio experience rather than feeling like your portfolio is, bouncing around with the overall markets. And then as we add in, some of the alternatives, the private equity, where have had clients exposure to SpaceX for the last couple of years, not in a public sense, but in a private sense. Some of the private lending as well, provide some of those buffers. And so maybe talk a little bit, Matt, about some of the alternative strategies that we've incorporated and how those have helped the overall portfolio, not only performance, but also the volatility.
Yeah, I'd actually bring up one of the slides here that I think does a nice job of showing that. I alluded to the tough month of March. Obviously the start of the war, those sorts of things that happened, and you saw stock market had a pretty substantial correction during the month of March. But a couple of those alternatives that you're alluding to really gave us that nice consistent balance within client portfolios as you're putting them together. So you can see there, at the low, the U.S. stocks were off about 7-8%. However, during that whole time, you notice that sort of steady blue line as we're moving, and purple lines as we're moving across here. You saw those held up really well for us, delivered positive returns that month, a little bit of buffer in the portfolio. So obviously, everybody loves a buffer when the market goes down. They don't love that buffer quite as much, but that overall fit and diversification is really key from a portfolio perspective. And you can see, this is one of those funds that I was showing you there. It's about a 9% distribution yield that we're seeing consistently from that fund, and it's paying that monthly. So consistent income coming into client portfolios. And if you look at the different types of investments, I threw this chart in here just for everybody to see. What you're seeing there is a lot of non-correlated types of investments, things like royalties or lending around legal settlements, things that don't really have any impact on what's going on in the market day to day. And so definitely seeing those benefits there. In addition to that, we continue to be firm believers in the Cliffwater Direct Lending Fund here. These are making loans to private companies, still yielding about 9.5%. I know there have been a lot of headlines out there around private credit, but this fund has done a really good job of sort of avoiding those pitfalls and continuing to produce that consistent income. Again, very well diversified between different types of loan lending that they're doing in the fund itself. And then, of course, Thomas, you mentioned SpaceX. So Friday's the big day,
Right.
and we have a number of clients invested in this private shares fund that is also making those direct investments in private companies. SpaceX makes up about 18% of the fund. So based on the most recent mark, if they come out at that target of a 1.75 trillion, that's a 40% upside that we should see on that 18% portion of the portfolio. So we're very excited about what should happen here. I have put in here when I put the slides together, June 11th or 12th, sounds like 12th will be the day as we go forward. So that should be exciting as well.
Yeah, I mean, I think it illustrates that we want to get access to multiple areas to get returns, adjusted returns for clients, not just the public markets. And one of the surprising statistics to me was that the amount of public companies in the early 2000s was around, call it 8 or 9,000 public companies. And now we've got about 4,000 public companies. So about half of the investable universe from what it was, 20 years ago. And one of the key drivers for that is companies can get capital elsewhere. And so if we're waiting, and I think SpaceX is a great, kind of case study. If we're waiting to invest when a company comes public, a lot of times we've missed some of that upside, right? You think, SpaceX when it started was not worth, nearly $2 trillion. But you had to be patient. You had to be willing to, have a long time horizon, and you had to be willing to give up some liquidity. And for some clients, that fits. And to get access into these private strategies is really where we're seeing not only some buffer in the portfolio, meaning not as much volatility, but really some future upside. And that one graphic you pulled up where it showed that some of the private strategies were up a little less than 1%. If that was the only thing you saw, you said, well, 1%, doesn't feel great on a monthly basis, but then everything else is down 5, 6, 7%. It feels pretty good. And so that's where I've really seen over the last couple of years where we've dealt with some real shocks to the market. Like we talked about, a couple of years ago it was Silicon Valley Bank. Last year it was tariffs. This year it's AI and the Iran war. There's always going to be these shocks. And that's where portfolio construction really comes into play. And so maybe Matt, talk a little bit about, I didn't mean to skip over your great stoplight graphic, but just share, a little bit about, kind of where we were kind of at the beginning of the year and kind of, how some of those things have played out in terms of returns within those specific categories.
Yeah, absolutely. And speaking of the power of AI, I did put together some great stoplights thanks to AI as we are working through this. But yeah, I thought it might make sense to kind of talk about, take some accountability for what we were saying at the beginning of the year. I think, it's been about 6 months, a little less than that, probably 5 months since we did this last and said, here's our outlook. And so everybody can hold us accountable for what we said. These were our keys as we started the year. We were cautious, the yellow light there on US equity, seeing strong earnings growth, but not sure if that could be maintained. We were wondering if AI impact could move beyond the Mag 7. We were concerned about inflation, obviously geopolitics, and then US stocks were just expensive. I mentioned that before. One of the keys, we took some profits there in large cap core. We were green light, excited about international equity because we were seeing that pickup in earnings growth. We were starting to see those countries as America was becoming more America focused, standing on their own and doing some stimulus, spending more on defense. They were also more attractively priced, and we were forecasting a continuation of the dollar weakness that we saw in 2025. And then finally, on the bond side, we were positive there as well. Green light, concerned about inflation, but we saw very strong balance sheets, low default rates. And if you remember, it seems like so long ago now, but we were expecting the Fed to cut rates, not raise rates as we move throughout 2026. And so we saw that as a positive from a bond perspective. And then the other sort of thing we were closely watching was these needs from the AI companies about significant amounts of capital to make the investments they were shooting for. So that was kind of our beginning of the year outlook. I don't know, Thomas, you have any thoughts you wanted to share about how we did in the first half? I've got the breakdown that we can get to as well.
No, I mean, I think that's a great overview, and our role is to really look at the both the macro economic information, and then how does that boil down to the specific portfolio expectations and needs of individual clients. And so, yes, it's great to have those perspectives and lay that out, and then how does that translate that you've already covered into how we construct portfolios. But then looking at, okay, as we start to look at the second half of 2026, we want to evaluate what was the actual return or overall portfolio impact of those perspectives. And I think that's kind of what you're going to lead into next.
Yeah, yeah. So here's our report card, if you will, in terms of how everything played out. So these are the results. I won't read everything. Obviously, we were trying to keep this as we talked about. You and I could talk about this for the next 2 or 3 hours. Not sure anyone wants to listen to us for that long, but one of the big winners was earnings growth. We were forecasting, the street was forecasting about 13%, which would have been an exceptional number after a very strong 25. Q1 was up 28% for the S&P 500. Estimate for Q2 is now close to 22% growth. So incredible results from US companies, just showing that despite all of the noise, all of the headlines out there, companies keep doing a great job producing products that people want to buy. If we look at the AI impact, a little less positive there. We've seen a huge growth in the number of startups. Actually, Apollo Group came out with a report saying that they called it an explosion. I used their quote there. And that's really a lot of AI driven, where we're seeing a lot of solo entrepreneurs starting businesses. But what we haven't seen is profit margins and revenue grow at some of the smaller companies. We'd really like to see that in the second half. So even though small companies did well from a performance perspective, we didn't see that AI translate downstream as we're working through. On the inflation side, certainly not what we were hoping for now. We came out at 4.2% was the CPI print this morning, and we weren't expecting oil prices to be up over $90. We were thinking oil prices dropped pretty substantially there. Obviously, as you talked about early on, Thomas, the unforeseen of the Iran war, which is where we've got the minus here on geopolitics. And then I'll give sort of one last plus before sort of get your thoughts on this. But valuation wise, valuations have actually come down a little bit simply because profit growth has been so strong. So that the earnings in the PE ratio has actually grown really fast, well above expectations. So we're better than we looked at year end, but still well above a 30-year average. So US stocks, we continue to feel a little bit cautious about.
Yeah, man, and maybe talk just a little bit. It was surprising to me, throughout the Iran war, and we're starting to see it ultimately start to materialize, but how indifferent the markets were in that first, call it 60 days of the Iran war, where oil started to get tight, prices went up, and we saw markets, reaching higher. Now, call it last 4 or 5 days, we're starting to see more volatility as maybe, the markets and investors are starting to think, well, maybe there's going to be, this is going to drag on longer. Maybe there's going to be, larger impacts. But talk a little bit about, maybe why maybe initially the markets kind of were indifferent, and now what may be driving some of the initial volatility that we're seeing over the last 4 or 5 days.
Yeah, certainly have seen volatility. We looked yesterday, markets were up 1% at the open and then down 3 at midday and finished almost flat at the end of the day. So certainly volatility. Yeah, in terms of reaction, we did have kind of that initial negative reaction, and that was the monthly performance I showed you there for March as we saw the stock market fall. But what I think investors, and particularly US-centric investors, have come to realize is we are significantly less dependent on oil or other energy inputs than we were 20, 30, 40 years ago. And so having that price move up doesn't have as much a direct impact. You think about the companies that are producing all of this money and all of the earnings like from the Magnificent Seven, they're not really dependent on having to deliver products someplace. They don't have those significant input costs from energy. Obviously, running data centers uses a fair amount of energy, so we've got a little bit of impact there. But it's not like our older economy where you were thinking about a trucking company that's driving across the country. A lot of the profit growth is coming from these companies that aren't as directly impacted by energy prices. But I think the other thing, Thomas, to your point, was the original forecast from the president was a 3 to 4 week experience in Iran. I think at that point it was being still called a skirmish. It's clearly drug on far beyond that particular time frame. And I think that's where the markets are starting to get concerned when we're seeing prints now on the CPI above 4%. Markets are starting to think, this is going to be higher for longer from a rate perspective. As I mentioned a second ago, markets were forecasting rate cuts at the beginning of the year. So just 5 months ago, people were expecting we'd have rate cuts. Now the expectation is the exact opposite. Most people are forecasting at least one rate cut or rate increase by the end of the year. Obviously, that flows through. And then, you think about the consumer. Job growth has held up really well. We had 170,000 new jobs last week, but the consumer wages aren't growing as fast as inflation is. And so at some point, I think markets are starting to try to figure out if this stays, what's going to happen? If we've got to pay more to fill our gas tank, what are we not buying on the other end? And most people can get through that for 3, 4 weeks. Now it's starting to become 3 or 4 months, and I think people are thinking it may even be longer than that.
Yeah, I think it just comes back to, it's in the markets, it's always going to be something. Markets don't go straight up, and that's kind of our job is to position, portfolios and clients to get the return that they need to meet their financial goals and manage the risk side of things. And so we're almost a little past the halfway point in our time. So maybe we shift gears and switch to kind of how, and I think, kind of summarize the first half from an investment and financial standpoint is we're pleased with how things are performing, and some of the changes we've made have really not only provided additional gains or return, but also provided the portfolios with some stabilizers or buffers to not feel the full brunt of volatility. And so now, as we've talked about some of the headwinds that we might be facing with an extended war, oil prices, inflation. How do we now look at kind of this second half, and what might we be watching that might cause us to kind of shift gears and make some additional adjustments to the overall portfolios?
Yeah, great question. So, as you and I spend our time, over the last week or so, kind of talking and doing our normal strategic planning as we're thinking about client portfolios in the latter half, I tried to put together sort of the same stoplight. I wanted to make good use of my AI use. And so I tried to put together the same thing. And what you'll notice if you look at just the stoplights, no change to our outlook as we move in the second half of the year. If we think about US stocks, continue to be cautious there. We clearly have seen some incredible earnings growth, but the forecast for the remainder of the year is almost 23% year over year earnings growth. That's a tough hurdle to meet. And so, at least in our minds, I think we think companies are priced a little bit for perfection at this point, especially when you think about oil prices and having some impact. I mentioned they're not as much of an impact as it was historically, but still some impact on profitability. Employment remains strong. Wage growth hasn't been strong. So the question becomes, if inflation holds up, is there more pressure on companies to start paying employees more, which again can hurt that profitability? And then obviously, the ongoing geopolitical conflicts. We've got a second half of the year here. We've got a midterm election coming up. Lot of issues there that make us a little bit cautious. The other big thing, as I mentioned before, is that productivity growth. AI is supposed to drive a lot of that. We're spending huge amounts of money on the AI. We haven't necessarily seen that translate from a productivity perspective yet, certainly not beyond the Mag 7. And we need to start seeing that if we're going to meet these 23% numbers, that analysts are forecasting. On the international side, we continue to be optimistic there. There is a bigger impact, though, of oil pricing on international companies. A lot more profitability comes from one, they don't have their own internal energy sources in a lot of cases, but they're still much more energy dependent, and they're paying significantly higher prices than even the higher prices we're paying. So definitely want to watch that. And with this political uncertainty, we've seen, as I said before, we were forecasting continued dollar weakness because that was a goal of the president. That has not happened as there's been that flight to quality, and as oil prices move up because they trade in dollars, we've seen some strength in the dollar to start the year. So that's been a little bit of a headwind for the international markets. And then we're also seeing early signs, throughout the ECB in particular, about talking about needing to raise rates. Now, obviously, they had really good, solid profit growth that we talked about. Increased rates can have a negative impact on that. So those are the things that we're going to be watching very closely. And then finally, in the bond market, headline of, as always with bonds, is inflation. We're optimistic if inflation can start to come down, if we can resolve the war, if we can bring those energy prices back down, that's a positive for us. We've seen really low default rates. They've actually been dropping recently. Will that continue in the second half? And then, the big one, of course, is our new Chairman Warsh, taking over here in mid-June. So he's got some specific ideas, Thomas. I don't know if you want to talk a little bit about that and sort of your outlook for what you're seeing and expecting from the new Fed chair as well.
Yeah, I think just going back, Matt, to kind of the macro level of things, and then down to kind of the Fed level, I think the underlying kind of outlook is the economy is okay, right? It's not hot, it's not cold. We seem to, there's some things that, some bright spots with jobs. There's some concerning spots with inflation and wage growth. But the earnings of companies is another bright spot. So there's a lot of good balanced things happening in the underlying economy and the macro things. And the other thing I think that gives us some positive outlook is some of the things that we're dealing with are self-inflicted, right? They're not systemic, right? The Iran war was a choice, not from a initiation standpoint. And once that gets resolved, then things can kind of go back. I wouldn't say back to normal, because I think the impact on oil may be sustained for a period of time as things get flowing again. But some of these, I guess my old point is they're solvable. It's not that there's something that's happening in the economy that is going to take years to work through, or there's some systemic issues with the economy. And as we kind of go to the Fed, right? I mean, they're kind of in a what we think should be kind of a holding pattern, right? When we talk about the economy being okay, right? If you cut rates, you usually cut rates because the economy needs a boost. You raise rates because you think the economy needs to cool off, and we're kind of at kind of a Goldilocks standpoint here where things kind of be maybe not just right, but close enough. And so, Warsh, I think, has a inclination towards lower rates, but he's an economist at heart. And I think given the way the Fed is structured, they'll be looking at the data and hopefully making some adjustments based on rates there. But they're kind of gotten themselves into a one-trick pony, and rates can only do so much at this point. And so I think looking at some of the other macro fundamental elements of the market and the economy gives us a little bit more insight. And you think about whether it's a 25 basis point raise or cut, that really doesn't move the needle significantly. What we need to get back to is there a consistent trend with rates rather than this 25 points up or down? You just think about your mortgage, right? If we go from 6.5 to 6.75 or 6.5 to 6.25, does that really, I mean, it has an impact, but does it really have a broad-based impact on how companies and individuals are going to start to make some decisions?
Yeah, I think that's a great point. And I was actually speaking with a client earlier today that had asked about the Fed chair and said that's one job I would not want, that's for sure.
Yeah, right. So as we kind of wrap up here, Matt, and look at kind of the broader kind of takeaways, what kind of message or kind of summary would you share with both folks on the webinar here today about how to look at the second half here, how we might be positioning, and some of the key elements that we might be watching?
Yeah, I think you hit on several of the things that are important there, and that is one, not to watch day to day. Everything changes as you're moving through, but yeah, really the fundamentals of the economy on a global basis continue to be strong. And I think over time, there's always noise, as you talked about in the market, always plenty of surprises, but over time, earnings are what drives market performance. And the earnings continue to be exceptional, really around the globe. If you look at quarter one and expectations here as we move into quarter two earnings season. And so I think focusing on the fundamentals, economic growth looks good. Inflation is up, but there's a reason it's up. It's because of the wars you talked about, which is a self-inflicted choice that as we resolve it and, for better or worse, with the midterm elections coming up, I don't think there's any choice but to resolve it as we move into election season here. And so from that perspective, I think you're going to see hopefully that inflation start to come down, move down below that 4% number. You remember, not that long ago, we saw some prints starting to come in that 2%, under 3% range, where we were all feeling quite a bit better about that. So again, I think those are the things to focus on. I think a couple other things just to always keep in mind is really the core philosophy for us here at TM Wealth, which is it's about time in the market, not market timing. And so it's always fun, and you and I do it every single week as we meet, talk about what's going to happen here over the next 3 weeks, 3 months, but really what's important is what's happening over the next 3 years. Focusing on that diversification, we're continuing with client portfolios to look at new opportunities, whether that's in direct investments. We had an opportunity for some clients to do a direct investment in a mental health opportunity, and also some AI data center opportunities have been out there that have made sense for certain clients. And getting that diversification, that one free lunch we can look for there, and really trying to drive back and tie back at all cases to that financial plan and giving the stable, more consistent returns over time, realizing the math of investing works against us. So we want to control those drawdowns through that diversification, that we started out talking about today. And I think that's certainly our focus to continue that as we move into the second half of the year as well.
Yeah, I think that's a great summary, Matt. I think it's important to remember we're investors, not traders, right? Doesn't mean that we don't adjust for, macro and fundamental elements, but we're not trying to capture price movements. We're looking at how do we make an investment that's going to provide returns over years and decades, not how do we decide if Nvidia is going to be 210 or 205 in any specific week. That said, clients have a lot of questions, and they get the headlines, and sometimes it's always helpful to have a perspective and a sounding board and conversation. So you can see Matt there's got his phone number and his email. If you can always reach out to your advisor and the team here at TM Wealth Management. But Matt also is available as well. And We get calls all the time about, hey, I saw this headline, or I got this, I saw this ticker, and what do you think? And I think it really is valuable to kind of talk through some of those thoughts and ideas before an implementation, and Matt's available to do that. With that, you'll everyone on the webinar, you'll be getting an email follow-up if you'd like slides or any specific questions about your portfolio, or engaging with TM Wealth Management. You can always reach out to us directly, or go to our website at tm-wealth.com and engage with us there. As Matt shared with you, our core philosophy really is to help clients make good financial decisions so that their financial resources can have the impact on the people and causes they care about most. With that, Matt, great. Thanks for the time today. Hopefully this has given folks some things to think about, and maybe calm some nerves about maybe what we're looking at for the second half. And we look forward to sharing some additional thoughts and insights with you as we do additional webinars throughout the year. Have a great rest of your day.